A 1973-74 recession is likely, with gold exploding 500% higher. What about silver? So are we about to see a 1973-74 style recession? And will we see silver and gold explode 5 times? Well, before we cut to a short clip from a recent interview with Tavi Costa, I want to remind our regular Finance Uncut viewers to make sure you stay tuned to the end of this video where I have a big announcement to make.
I don't think we're going to see a lot of, I think this is going to look like 73, 74 when we've had that decline in equity markets was about, 25 to 30% decline. And then the Federal Reserve was basically forced to pause their interest rate increases and actually had to reduce interest rates at some point. But basically, we went on a pause for a couple months there, or more than a couple months, until we resume interest rate increases because of oil prices increasing. And the similarity here is because I think that the level of monetary tightening on top of what we may see with consumption falling off a cliff may actually cause a steep recession here. Watch what's happening with the yield curve. The yield curve is now, you look at the Federal Reserve hiking cycles of the last 30 years. It's quite interesting that every time we've seen yield curve inversions to the levels that we've seen right now, usually that causes the Fed to pause. And so what is scary, though, is that inflation is completely understated in terms of what government is reporting. However, it has been, in terms of a pace, decelerating all the way back to March. You look at commodity prices have come down. Majority of things have come down significantly from, I shouldn't say significantly, but slightly from March, not only commodities, but actual price of things. And so the problem with this is that the Fed is actually accelerating as the pace is declining. And so the part of the pace to being declining as well has to do with consumption and economic activity slowing down drastically. And so to me, that's the concerning part, is that tightening cycle as the economy is starting to show some issues. And so I'm quite concerned we're going to get into a recession here very quickly. So I think this is what causes the Fed to have to reverse its policy.
So Tavi thinks that we're going to see a 1973-74 style recession. And look, I've been calling that for some time now. Why? Because a lot of similarities between what happened then and now. Nothing ever is exactly the same, but it's definitely rhyming. So let me give you a bit of background on that 1973-74 recession. So a lot of people call it the oil embargo recession. Certainly oil prices played a big part in it. But we had unemployment during that period. That peaked at about 8.6%. CPI peaked at 12.5%. And the federal funds rate peaked in this period anyway at 13%. But we saw oil shortages. Well, what do we see today? We saw oil prices skyrocket back then. Now, I still think oil prices are going higher. Back then, we had a devaluation of the dollar amid high US trade and budget deficits and slipping domestic crude output. Well, do we have a slipping domestic crude output happening due to a particular president's policies? And with CPI beginning to get out of hand, you had the Fed doubled effectively the federal funds rate to 10% between late 72 to the middle of 73. And then, as I said, ultimately peaking at about 13% in the first half of 74. And then CPI rolled over. Peak inflation, guys. Hear that today, don't we? And so it rolled down. It rolled over, started coming down, and the Fed cut rates back to 5.25% from memory. And, well, you guys know the rest of the story of the 1970s. So, actually, here's another chart that shows the S&P 500 index and the US 10-year yield. So some of the things that I'm expecting. So we've already had the stock market. We're in a bear market. I expect that to continue. As I said, I believe oil prices will go higher, maybe even double from here. Let's wait and see. Some other analysts have got oil going to over $300 a barrel. So, if certain things play out, that's a possibility. But I definitely think oil prices and energy prices, due to our own policies, are going to remain elevated this decade, but definitely in the coming little period. And commodities will go higher as well. So basic, everyday basic needs will go higher, and obviously CPI. Have a look at a chart of oil and CPI going back 50, 70 years. So as the stock market continues to fall and commodities continue to rise, we'll see more people rotate from shares into commodities, further reinforcing this cycle, which I've been talking about for some time. So there is a major difference between the 1970s and now, though. And before I come to that, let's just cut back to another clip with Tavi Costa.
To me, stagflation is an environment where I think we all like to look back in history and think about, what is the best analog for where we're seeing today. But today is a completely unique environment. Why? Because we have a trifecta of macro imbalances. We have the debt problem of the 1940s, the inflation problem of the 70s, and the valuation problem of the late 90s during the tech bubble. And so it's hard to believe that the Fed has any flexibility to prevent inflation from persistently infiltrating the economy. And so it is a very, very difficult job right now to be a policymaker. And to me, that's going to translate into higher gold and silver prices. This is precisely why we buy a lot of exploration assets that we think are going to do very well in the next 5 to 10 years. Literally, I mean, this is a long-term play that I think is as attractive as it gets, especially at depressed levels that we are today.
So Tavi really summed up the problem that we have here. We've got the debt problem of the 1940s, the inflation or CPI problem of the 1970s, and the overvaluation of assets of the late 90s, 2000. And, I still believe that interest rates will go higher than where they are today, but the question is, can highly indebted government, sovereigns, and households handle this? And the major difference between now and 1970s, obviously, is those debt levels. They're way worse, whether it's a sovereign household or even a corporate level. So what's going to become very important is what are real interest rates going to do longer term. So after inflation, we think real interest rates are going to be go even further negative, and central banks will hit a point where they cannot raise any more. But you'll hear economists. We're hearing a lot of mainstream economists right now talking about how supply chains are coming back. Borders are opening. We're going to have mass immigration again, and things are going to be rosy because they think that is in the rearview mirror and that we're going to get back to normal. But I believe with the policy changes, with the damage that we've done to the global economy in the last 2 years, and with the currency debasement, people are gonna feel rising inflation, rising interest rate, and a stagnating economy. We're going into stagflation. We're going to have a recession. The question is, how big a recession and what type of recession? So, when recently increasing the OCR, the overnight cash rate, the Reserve Bank said, and I quote, headline CPI inflation is well above the Reserve Bank's target range, but will return towards the 2% midpoint over coming years. the near-term rise in inflation is accentuated by higher oil prices, rising transport costs, and the impact of supply shortfalls. The inflation of the 1970s didn't end in 2 years. It took a whole decade. It started, you could argue, in the late 60s. I shared a chart before. It took a whole decade. Yeah, CPI rolled off from peaking in 1974. But we know what happened in the 1970s. So the question I want to ask you guys, how likely do you think a return to 1 to 2% inflation is within the next couple of years? And if you think that is likely, you don't want to buy gold, silver, or commodities. Simple as that. So here's a chart, the S&P 500 bear markets from going back to 1945. And you can see the 1973-74 recession is the third from the right. A large recession with also the S&P 500 drawdown. So almost 50% in nominal. This is nominal terms. Now, some bear markets non-recessionary, as you can see. I believe this one is going to be a global recession. This is going to hurt, and we're going to see a big drawdown in asset prices in general, because housing is also very much correlated with interest rates, because that affects people's purchasing power. And with the indebtedness now, we are very, very, very sensitive to rate movements, both down and up. So I think we're going to have a 1973-74 style event as well. But as Tavi mentioned before, we've got the 1940s debt problem with the 1973-74 style, or the 1970s inflation or CPI problem, energy crisis problem with a 2000 valuation problem. So with that, let's just cut back to our final clip with Tavi Costa.
Miners may get caught up here and there, and it's important to remember a very key moment in history when we had stagflation was 73-74. Equity markets declined about 50%, as I noted recently, but also you saw gold miners actually go up fivefold during that environment. So while a lot of people like to go back to 08 and 2020, and when we had equity markets getting crushed and gold miners being dragged along with it, there are times in history that we had stagflation, not in 08 and not in 2020, when actually gold miners did very well during that environment. And that's mostly because you see inflation rising, and the Fed is in a recessionary environment and can't really do much, and it has to allow inflation to continue to rise.
So I've said this over and over again, but 73, 74 as equity markets collapse and the economy entered recession. Long-term nominal yields increased. Such market developments are consequences of the economy facing long-term inflationary pressures rather than cyclical forces. We think treasury yields and equity market correlations will look similar in this recession. So, but, contrary to today's conventional wisdom that you'll hear from mainstream economists and whatnot, and those talking heads on CNBC and all the other financial news stations, check this chart out. Note how gold miners increased fivefold while the stock market declined 50% during that 1973-74 inflationary recession. So we think a very similar development will follow in this current downturn that we're in. So we are bullish. Miners, explorers, the whole gold, silver, and commodity sector, obviously the underlying metal as well. So I've shared this chart numerous times, and you can see in that 1973-74 style recession, gold did exceptionally well. So that's the underlying metal doing well. And then, as you saw from the Barron's Gold Mining Index, that that went up fivefold. And so once again, the miners have that leverage. The explorers have even more leverage. And well, we've been jumping back into the market in recent times in quite a big way and looking to take advantage of this smashdown in prices. Both, well, you think gold and silver's been smashed down, the actual metal. Well, a lot of miners, and especially junior miners and explorers, have been smashed down even more. So I really wanted to share this chart with you guys. Value factors have massively outperformed historically. And you can see small value. So I invest a lot in the small cap space. And as a value investor, I look for value. I've shared before how I bought coal stocks in 2020. I bought some coal stocks at 1.8 times earnings. Other coal stocks, I sold out of my Peabody, made a 10x gain in just over 12 months. So very happy with that return. Still hold those other coal stocks. Another coal stock, based on my purchase price in 2020, I got paid a 56% dividend yield. The other coal stock that I funnily enough bought at 1.8 times earnings looks like I'm going to get close to a 60% dividend yield on that one. So, and that stock did go up 5 times. It's pulled back a little bit, but it's still up 4 times from where I purchased it at. And just in recent weeks, I've been jumping back into another stock, which is a drilling company. Provides specialized surface and underground drilling for exploration and mining clients in Australia. Guess what? It's got a PE of 3.5 times earnings. So I jumped in at 3.5 times earnings. Got a dividend yield of 7.5%, which our analysis by 2024 will be about 11%, and that's fully franked. So that's about a 13.5% grossed up yield. With a 50% payout ratio. They just announced this week a 20% increase in revenue, 47% increase in net income, 23% increase in net profit margins, 25% return on equity, and 27% return on capital. So very well managed. So every investment, every dollar that I put into the company, management are returning, giving me a good return on that. They've increased their margins per rig, so they added 15 quality rigs in the last year, with another 11 being built, and they increased that revenue per rig by 7%. So just a fantastic company, and that's at 3.5 times earnings. And they've just announced with this, once they announce these results this week, that they're going to begin a large buyback program. So, and then 2023, their outlook, and to be honest, our analysis is very similar to their outlook. In fact, I think they might even be conservative in their outlook, and that's for margins to increase. And that's a net, so their net margins, so above their costs, they're able to increase their margins significantly. And growth due to the rebuildable energy demand. This is a space that they're specializing in particular. And I think the growth is good. The amount of mining and minerals needed for this energy transition is just insane. And so, yeah, and they've got a dividend policy of 30 to 50% of net profit after tax, or operating net profit after tax moving forward. So they're paying a huge dividend at the moment, 3.5 times earnings that I bought this stock at. By the way, when they made this announcement, the stock jumped up 20% overnight. This is a stock that I believe has huge upside growth in the share price. So, we're looking for a 10-bagger here. At the same time, because it's got so much growth in its revenue and earnings, net income, and they've got a policy of 30 to 50% payout ratio, while at the same time buying back stock and reinvesting into the business, we're going to get pay rises. I'll take a smaller dividend yield if they have large increases in earnings and obviously grow their dividend. I like getting pay rises each year. I don't know about you guys. So in an inflationary environment, this is a stock that I absolutely love. And on that, I've had a lot of feedback from people wanting more information about my portfolio, and I've done a couple of videos where I shared my portfolio. So a couple of weeks ago, I did this video, Investing Lessons from Buffett, where I shared my investment philosophy. And so I've had a lot of questions and a lot of people reach out to me, and I've decided that I'm going to build a platform for Finance Uncut Insiders. That's what I'm going to call it, Finance Uncut Insiders, where I'm going to share my own portfolio, which is predominantly Australian and US based. However, I do hold and I do invest from time to time in Canada, Japan, Russia, India, and Indonesia. So I will share my whole portfolio, all my investments, where I'll also provide all the research and analysis that we do on each investment we make, like I just shared on this drilling company. And I'll also share why I'm buying certain investments or why I'm selling certain investments. Once again, it won't be financial advice, but I will share my portfolio, what I'm doing, and all the research and analysis behind it. And if that helps you guys, understand more, become more educated, and then make your own investment decisions, then let me know in the comments if you're interested. I will be sharing, once I build this platform, I will share more details in future videos. So I'll leave the last word to this tweet from Chris McIntosh from Capitalist Exploits. Before the decade is out, we're all going to understand the difference between currency and money. Couldn't agree more, Chris. Anyway, guys, if you like this video, would you do me a big favor and hit that like button? Give us that thumbs up. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Do you think we're going to see a 1973-74 style event, or do you think we're going to see some other type of event, or is this a whole new event that none of us have ever seen before? And also, don't forget, if you'd like more information about our Finance Uncut Insiders, once again, leave a comment below and I'll get back to you with more details. Take care, everyone. I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.